The professor is full of energy. Thank you, sir. That is the chairman for this inaugural plenary session, a very crucial session and is central to what we are discussing today. Can we also have Baba joining us on the high table? Professor Eguga, Dr. Eguga. The speakers are Professor Akin Iwayemi and I don't know who is presenting. Okay, the two, both of them. That's open-ended. We have a joint speaker, Professor Akin Iwayemi and Adeola Adenikiju of CPIL, University of Ibadan, talking on development in global oil market, causal factors and prospects. The second speaker, Professor Sam Olofin, Dr. Olubusoi and Dr. Apis Salisu of SIA, UI, speaking on impacts of oil price decline on the Nigerian economy. Can we have the speaker here? Professor Sam Olofin. Okay, no, it's Dr. Olubusoi. Round of applause for the speaker. Thank you. The third paper is from Mr. George Osahon, the director of DPR, Department of Petroleum Resources. It's an invited paper speaking on the impact of global oil market development on E&P in the Nigerian oil sector. I believe E&P is engineering and procurement. The fourth paper is on declining oil prices and oil exporting countries, strategic options, to be given by Dr. Paul Michael Wibby, all the way from Pennsylvania, G West, Pennsylvania. Yes, Professor Lopez is here. We'll call you, sir. Thank you, sir. Then can we have Dr. Paul Michael Wibby, if he's in the hall? Yes, Professor Wumi Ledari will take that paper, Declining Oil Prices and Oil Exporting Countries. I hope you know that Nigeria is an oil exporting country. Strategic options. So this paper, all the presentations and discussions should terminate by 14:15. That is 2:15, so that we'll have lunch break. Over to you, sir, Mr. Chairman. Professor Anyakai.
Good afternoon, distinguished ladies and gentlemen. It's a pleasure to be here in company of my very good friends. This session is the first plenary session of the conference, and the speakers are, as already announced. Luckily, we have all the 4 presentations here present, but the 4th one is present by proxy. And Professor Plenary has kindly agreed to share his thoughts with us. So without further ado, since we have a total of about 1 hour, 45 minutes, no, about 2 minutes, no, about 1 hour, 45 minutes, but we'll see what we can do. Let me therefore offer each of the speakers upper limit of 15 minutes. Is it too low? 15 and upper limit of 20 minutes, 15 minutes. By then it's 15 minutes, I will start letting you start finishing your delivery. Okay? That said, let me therefore request Professor Aki Wayemi to kindly make a presentation on behalf of both of them, himself as President of the Society. That is, and the topic is developments in global oil markets, causal factors, and prospects. Thank you very much, Prof. 15 to 20 minutes. Round of applause for him, please.
Thank you, Mr. Chairman. Two of us will be making the presentation. I'll start first. Our paper, as you can see of the board, is on world oil market development, analysis of historical trends, and future prospects and implications for Nigeria. So our paper will be in 2 parts. The outline of our presentation is what you can see there. Briefly give an overview. Then in the second session, we try to look at an interpretation of the development in the world oil market from the economic perspective. Then we will ask the question where the oil market and price is headed, and thereafter look at the implications for Nigeria in the context of the changes that are happening in the world oil market in recent time. And then we'll have concluding remarks. Well, those of us who are conversant with the development of the world oil market will know of the turbulence in the world oil market, highlighted by the dramatic changes in the price of crude oil from about $114 a barrel June last year to less than $50 a barrel early this year. But there's a revival, restoration, and prices are coming up to about last week, about $62 per barrel for Brent crude. This price development actually is almost similar to what happened 30 years ago, when there was also a market turbulence in the world oil market, and prices of crude oil crashed to less than $10 a barrel at that time. Okay? And so this latest development suggests, again, further confirms the uncertainty and risk in the oil business, and the unique nature and also dynamic nature of this industry, you know, in terms of developments and its implications for the rest of the economy. So it's important for us to try to interpret this development, and because certainly a good understanding of what is happening is essential for characterizing this development, but more importantly, in terms of the implications for both national, regional, and global economies and financial systems. It is important to stress that the industry is characterized by changes in industry is characterized by structural and non-structural factors, and particularly the institutional mechanism under which the industry operates, creates such, factors that make the industry in more recent times very difficult to predict. Okay, as we see in the market, certainly price volatility has increased. A lot of work has been done in this area. We're going to be lower that. Secondly, is the competition for what I call competition for and consolidation of market share by what we call the marginal suppliers, which has actually led to the recent collapse in the prices, led by Saudi Arabia. We'll talk about that later on. And so these very important strategic resource in international trade, affects human livelihoods and development. And so it is not surprising that politics and economics and geology and financial system come together, to create a very complex industry and the development in the industry. Okay? So, against this brief description, against this background, two questions are important that we try to address in the paper. Okay? First is, what is the prospect? That what is happening now, is going to transform the industry in such a way that, like what happened in the 1970s and 80s, will also be replicated. In other words, there will be a paradigm shift in the industry. Secondly, and more important, that's where is the market heading? And what are prices, where are also prices heading? These questions are important, especially for us in Nigeria, because of the dependence of Nigeria of oil, although that dependence is declining in more recent times. Okay? So we're going to look at the oil market. Generally, we're going to look at its impact on the Nigerian situation. Actually, our focus will be on looking at the Nigerian situation and the implication for us in various dimensions, as you see later on in the presentation. Okay? We briefly looked at an economic theoretical paradigm that has defined, the development in oil markets with respect to both market structure and prices. And essentially, three things have been highlighted here. First is the institutional structure, what is happening in the world, what has been happening in the oil market, especially from the 1850s to the current period. And then the structural demand and supply factors that have impacted the market, and then what we call some non-other structural factors. Well, let's start with the institutional factors that precondition how the market develops and evolves in terms of prices, investment, and even output. Okay? Now, when we look at the pre-1970 period, we see that the industry was dominated by the multinationals. You don't have to believe that. Okay, and they were in charge, total charge of what was happening. And essentially, their control of the market, in the context of an oligopolistic market structure, was such that they were able to control the market through their control of excess supply, so that there was relative price stability in the system. That was the first phase. The second phase now was the private oligopoly was replaced by a public oligopoly, where OPEC became the dominant factor in production and in the market, and had an important influence on the trajectory of prices in the market. Okay, but OPEC could not play the same role as the multinationals because their system did not have the same kind of global reach that the multinationals had. And so price stability and sharp increases and declines in prices became more prominent in the market. And then the third period is the post, or what I call dynamic entry of shale oil and gas into the market. This seems to have led to the current problem, where the stake of some of the public oligopolies to establish, confirm their shares in the market, led to excess supply oversupply, and the crash in the oil market led by Europe. Okay. Now, in interpreting the development in world oil prices, an important paradigm has been the Hotelling theory of exhaustible resources, for those who know that area. But essentially what this paradigm suggested was that in the long run, actually, oil prices, the price of a natural resource that is exhaustible, will increase at the rate of interest. Essentially, that projects to saying that price of crude oil will increase over time. That was the basic paradigm of this non-renewable resource based on Hotelling. But empirical analysis has shown that the Hotelling paradigm could not explain or interpret fully what had happened in the world oil market. So with the failure of this, other alternative interpretation of development in the oil market was also provided. That the demand and supply analysis, that prices will result from interactions between demand and supply. And empirical models also have been constructed in this area to try to provide a basis for forecasting oil prices of the future. And these projections have been found also wanting because of the sensitivity of many of the models to changes in certain key parameters, that affect the model, including price and income elasticity. So many predictions in the oil market with respect to future oil prices have been, I don't want to call them, they are essentially have been failures, let me say, and not be able to capture a lot of the developments in price movement for a long time because of the nature of the industry. There's also the role of technology in reducing cost of production, of producers, so that people, market agents, participants now can go to deep offshore to produce oil at a lower cost, and all areas that were economic before have now become more exploitable. Finally, there's the geopolitics of oil. So in terms of model structure of predicting the market, we are faced with a number of challenges, but we are still trying to refine models to explain and interpret the market. But the complex nature, as I said earlier, of economics and politics and geology makes prediction a little more challenging. Now we then looked briefly to look at the historical trends, movement in production because of time. And you cannot see all of this. We try to look at, it's too tiny, from 1965 to 2013 annual figures to show demand and supply pattern and real price of oil. But unfortunately, you cannot see some of these things when you get see. Okay. OPEC has been a major player in the market. It's still a major player. Okay, and currently I think about 1/3 of global supply comes from it. So it's a dominant marginal supplier, and depending on how much it puts on the market, can determine the direction where crude oil prices will move, and that's what we saw in the last 1 year when Saudi Arabia, the most dominant of the marginal supplier, decided to increase its production, and OPEC could not agree on the production cut, and prices came down sharply. Okay, because of time, this graph is to show you the trajectory of crude oil prices actually way back when oil started. And you can see the gyration, there. Actually, the more volatile data between, actually since the 1970s, and the crash more recent time. So where are oil prices heading? Again, it has been a risky business trying to project precisely what oil price will be. But experts and analysts have given a range, and we are also suggesting that, given what is happening around us, a range of between actually $60 and $80 may be a range that is feasible in the current market condition. So we will suggest that in the near term, for the rest of the year, that we should not expect anything above $80 a barrel. My colleague will continue the remaining presentation on looking at the Nigerian case.
Thank you so much, Prof. I think we are delighted to have, just before I continue with my presentation, we are delighted to have the keynote speaker here with us this afternoon. I mean, like I said, it's been a whole lot of, efforts for him to be here. So it's our pleasure to bring to the high table our keynote speaker, Mr. Austin Aburu, the CEO, Seplat. Okay, quickly, I want to look at what should be Nigeria's response. What are the challenges before Nigeria in the light of the challenges that are taking place, or the reforms or changes that are taking place in the global energy and oil market. And we basically look at some areas that we thought are really very important. One thing is very clear. I'm persuaded that what we are having now is a new global energy market that is, unfolding before our very eyes. It may not be like we used to have in the past. I believe, and like I said in my opening statement earlier, that just as we had transition from coal, various energy forms that existed over time, we may be in a stage of transition from oil. It may not be in the next 10, 15 years, but some developments are actually taking place. And Nigeria needs to be aware of that. I hope I'm not just using this thing well. Is that? Sorry. What is it? Can you just check? Now we look at 5 areas. And if, okay, sorry, okay, thank you. Okay, thank you. Now, the implications on value addition and the domestic oil and gas market. We think there's a very huge opportunity for Nigeria now to start seeing how we can deepen and integrate the petroleum sector with the rest of the economy. Now, if you look at the data is very clear. Oil, the petroleum sector accounts for presently less than a quarter of our GDP, but contributes over 70% of government revenue and almost 95% of foreign exchange earnings. So there's a mismatch between what is contributing to the economy and what is, in terms of, output, addition, and what is bringing in terms of fiscal leakage. So the implication of that is that we produce oil, crude oil, in its primary form, and simply export that to make money. Now, that's not a sustainable way for a country that has over 170 million people. We must find a way of integrating that sector with the rest of the economy so that the contributions to revenue can be matched with its contribution to the rest of the GDP. And now, if you look at the data, some of the studies we did in the past, you look at the output multiplier, the employment multiplier, you will see that the output multiplier for Nigeria and the employment multiplier of the petroleum sector is actually very low, much lower than what we have for other sectors of the economy. So that means that there must be a way. The country must find a way of going beyond the talk and actually start implementing the deepening and the integration of the petroleum sector with the rest of the economy. And so we recommended that there must be a new policy to revive the downstream sector. The downstream sector is currently in comatose in this country. The government will use a combination of policy tools, monetary, fiscal, trade, whatever it is, to do this. People have suggested also that oil companies should be forced, should be compelled, and I would like to know Mr. Abro's opinion with respect to that, to actually refine a certain percentage of their oil locally in the economy, locally. And just as we have presently with domestic gas obligation, there should be something like that also in the oil sector. Okay, I've mentioned multiplier, that's the data, and the employment multiplier. Now, predicting oil prices and the Nigerian budget price. Now, the Nigerian budget is driven primarily by oil. And so, a fundamental factor, a critical factor is the price of oil. What is the price at which oil will be sold? Now, that is important in deriving what is the revenue projection for the country. And so, the good thing that Nigeria did was to actually, since 2004, we had 2004-2006, this oil price fiscal system, where the oil price is defined outright before the budget, very early in the budget, the fiscal rule, where it is fixed based on some geometric mean of the past values of oil and some outlook. Okay, but what is usually done is that price is set at a conservative level that is lower than what the actual price is. And the essence is to actually create a pool of surplus that can be used during the rainy day, when the price of, and also to mitigate against volatility of the budget, of the budgetary system, of the fiscal system. Now, we were implementing that using the essence code account, but we all know the issues that arose with that. There was no legal backing supporting it. It created a lot of challenge, and then we transited to sovereign wealth fund, which I think we need to sustain. So our position is that yes, the sovereign wealth fund is the way to go about it, but it should be, the manner of its management must be transparent to all the parties, and they must be part of it. So we need to go ahead. It's not to scrap the sovereign wealth fund or the oil price fiscal system, because it actually provides a way of reducing the volatility of the transmission between crude oil price volatility in the world market and the domestic economy. So this is our view that that really should be done. We should continue on that trend. But we also think that in the long term, the current system where our budget is solely financed, and most of it goes to recurrent expenditure, that there must be a way of decoupling the oil revenue and the budget, so that the money we make from oil, which is a wasting resource, should actually go to financing capital expenditure. Okay, so we should do more of getting, non-oil revenue to finance recurrent expenditure, and more of oil revenue to finance capital expenditure. Presently, that's what is going on. We spend more of our oil money to finance recurrent expenditure, and we borrow to finance, capital budget, and that we don't think that is sustainable. Okay. Well, and fiscal regime, we're thinking about decoupling, because presently you find out that many of the states they are heavily dependent on what comes from federation account, and what comes from federation account is the same dependent on what happens to oil. So with the declining price of oil, many states are finding it difficult. In fact, they are becoming almost insolvent. Okay, so we need to look at our tax base, our tax system, our revenue system. And again, you look at the budget, you look at GDP. The non-oil sector accounts for over 75%, over 80% of GDP. And yet, it brings in less than 30% to government revenue and less than 5% to foreign exchange, to our foreign reserves. So, that means that while there's a lot of tax avoidance that is taking place, or many activities are not captured through the tax system. So, this government must find a way of looking at this so that, the non-oil sector can actually bring in a lot of money that will then reduce the fiscal system of the country being overtly dependent on what happens to oil. The area I want to go, and I will quickly run through that, is the issue of subsidy. I mean, subsidy has become a very, very political issue in Nigeria, very, very divisive as it were. But our position is this. Presently, quite a significant proportion of our domestic oil consumption, refined gasoline consumption, actually is imported. Okay, so we import that. And if you look at the PPRA template, you will find out that the cost of the product and freight constitute about 71% of the total, open market price of gasoline. So 71% constitute that percentage. So now, if the price of oil goes down in the world market, one way we can look at it is that it should automatically reduce the amount of subsidy that government is paying. Okay, so it's a two-edged sword. When the price of oil goes down, what government pays for subsidy should go down ordinarily, and also we know that it will reduce what government earns. Okay, so you have this interplay of two factors that are at play. But what is of more concern to us is that you can't see the table, but I think it's quite, yeah. We tried to work on this table a few days ago. Now, a lot of Nigerians are saying that the price of oil is coming down. Why is the pump price of oil not coming down, correspondingly? And the answer is very simple. What drives the price of oil? Two factors I mentioned. I said one of them is the product price. The other one is the exchange rate. Now, the exchange rate is very critical. Now, if you can't, sorry for the PowerPoint we are using here. You may not be able to see this. In January of 2015, the exchange rate was at 171 naira 30 kobo to $1. Okay, the price of a barrel of oil was $60. Okay, now if you do all the arithmetic, the calculation is that the open market price should be 89 naira, about 89 naira. Now, if that exchange rate remains the same, and the price of oil were to decline from $60 per barrel to $50 per barrel, then the open market price should have declined from 89 naira 90 kobo to 79 naira 12 kobo. But what happened? We also discovered, yes, I think I was just kind of around here. But what happened is that the exchange rate was devalued. Okay, so the present exchange rate is actually 197 naira. So there's a jump from 171 naira to 197 naira. Now that has implications. So even when the price of oil falls from $60 per barrel to $50 per barrel, the open market price will only change from 89 naira, 89.9 naira to 87 naira, 27 naira. So you have less than 1 naira change because of the counteracting effect of the exchange rate. That is one of the challenges that we have with depending on import. So we need to revive our domestic refineries to ensure that we can avoid this kind of issue. Now I know that, and I'm sure that Mr. Abro will be speaking on this. The oil sector needs reform. I mean, we have a bill. The current act is 1969 Petroleum Act or so. I mean, definitely the oil market, the oil industry has changed, has evolved. Our PIB is under a lot of review, a lot of challenges. But whether it is passed or some part at the current stage, we needed to look at that PIB again. So, in conclusion, the question that we need to resolve, we need to ask, is that is the current oil market dynamics part of the past cyclical pattern we have been seeing in the past? Oil has been the volatility that we have experienced in 1973, or are we now in a new normal? Okay, I think that is the question that we have to find answers to. Thank you very much.
Well, thank you very much, Prof. Sorry for rushing you. I know it will give you the whole day. You will not keep us speaking at all. Thank you very much for the presentation for both of you. Now, distinguished ladies and gentlemen, my instruction now is that the keynote speaker is here. And it's only fair. I haven't taken all the time to come because the challenges of traveling in our environment is still persisted and is here with us. And as CEO, you don't see them for too long. So since we have him for this brief minute, let's take the maximum advantage of his presence. And with your permission, I would like us to create a space for us to hear him within the next 20 to 30 minutes so that I can give his keynote address. And then we can then return to our normal schedule and then proceed thereafter. So I think that nobody is objecting. Thank you very much. So may I therefore, okay, let me hand over to Professor Elidare, who will now kindly do the proper introduction of the keynote speaker. Prof.
Thank you very much. I want to take the delight to introduce him so that you can appreciate his coming. And I hope you'll be kind enough to applaud him even as he goes there. He's a very busy man. Actually, he left Warri this morning at 10 a.m. to be able to get here and then having an understanding of what it takes. I thought I want him to know that it's a great appreciation that you are joining these young, emerging professionals. I know there are some elderly ones among them, but the majority of us are very young professionals. Engineer Austin Avuru is the managing director of Seplat, one of the emerging oil and gas indigenous company in Nigeria, and they actually listed on the London Exchange, and he is an alumnus of this great university, the great, yes, and he has enormous experience with respect to the oil and gas industry, and his experience is very vast with respect to not only limited to the professional aspect, but even the geopolitics of it. And it's really a pleasure and with great, great delight and full of appreciation to have you join us. Please welcome to the podium.
Distinguished ladies and gentlemen, professors, chairman, I have a lot of apologies to offer before I even start. It looks like my apologies will even start from the sheer size of the text of our view graphs. I hope we can go through, but I will try with explanation such that even if you are not looking at the view graphs, you can understand. My first apology would be with respect to my dressing. I will normally be formally dressed to come to give a keynote address in a gathering like this. But everything conspires to make sure that I do not make it to this event today. We had an event where we're dedicating a hospital in my community that, thanks to God, I had built and handed over to the Catholic Church. And this was supposed to happen on Saturday, and then on Saturday, they had rerun elections in Delta, which meant that people couldn't move around. We had to move the event to yesterday. And I had planned to return yesterday evening to Lagos and drive to IBADAN this morning. But we had the event yesterday, all through. And then I made special arrangements to leave Warri at 8 this morning, so I could get into Lagos by 9 and drive to this place by 11. Then the weather conspired and no plane could get into Warri before 10 o'clock. So we didn't leave Warri until 10:15. Got into Lagos about 11. And to get through the Lagos airport in Keja to get to toll gate took us 45 minutes. So I was already 45 minutes late to this event when I was leaving Lagos. Thanks, the express road itself wasn't too terribly bad and made it here. So anyway, thankfully I'm here. Of course, because of all that rush, I couldn't get home to change and dress properly. And so here I am looking like I'm going to watch a movie. So I apologize for that. I'll talk you through. Let me give you my summary before I start. I'll put you through a few policies in the past in Nigeria and the aftermath of those policies, or what those policies led to. But essentially, at the end of my presentation, what we are going to be recommending, as it were, all of us, will be that our policies in the oil and gas sector, and a lot of it the Prof mentioned, if you have a sector that contributes 14% to your GDP and 85% to federal earnings, there's a major distortion, something wrong. So we're going to see what the policy direction should be looking like if we have to, one, increase the contribution of the oil and gas sector to GDP, and also derive maximum revenue earnings from the non-oil sector, so that there's a balance between GDP contribution and contribution to federal revenue. As I said, it's going to be tough for you to look at. But essentially, that is just telling you the different periods of entry and exit of different companies in the Nigerian oil and gas sector and the key policies that led to these exits and entry. First of all, in the 60s, we had a bunch, most of the key companies that are still here, the big ones, Shell, Mobil, Chevron, Texaco, Elf as it was then before it became Total, and Phillips. Those were the ones that were here right from the opening up of the sector in 1960. Before 1960, it was only Shell. After the opening up of the sector in 1960, those 5 key other companies came in, and they all dominated the landscape between 1960 and 1971. It didn't take until the 80s and 90s before some independents were allowed to come in, again through some change in policy. Some independents were then allowed to come in to add to the so-called six majors that dominated the space. Let me also say that for probably about 12 years from 1962 to 1973, oil price remained constant at about $2. At that time, it was practically fixed by the majors, the same big boys who sold it. Just fixed the price. It was $2. It was only in 1971 with the formation of OPEC and producer agitation, that's the producer countries, started having a say in the price of crude oil, that we started seeing the shock, such that between 1973 and 1980, just a period of 7 years, oil price had gone from $2.7 at the lowest at the beginning of 1973 to $35.6 in 1980. That's how fast it rose. So from 12 years of the consumers deciding the price and keeping it flat, we moved to a regime where the exporters, the OPEC countries, determined the price. You all remember those days after every OPEC meeting, with cigar brandishing oil ministers from the Arab countries will come out of the meeting and announce the official selling price of crude oil. And then by the time we got to the mid-80s, 1985-86, when we had the first price shock, crude oil price had crashed from $37 to $18. So here we were beginning to see the interplay of demand and supply actually coming into the pricing of crude oil for the first time. As I said in the beginning, it was fixed, low price, convenient for the consumers and the main companies, the operators who had also all the refineries. And then came in OPEC who fixed the price, that is producers fixing the price, and then we started having this interplay of supply and demand. And since this setting in the 80s, that interplay has continued, even though it's been impossible for anybody to predict the price of crude oil. It's been impossible. Because this interplay is very complex. Now, again, this is coming back home. I will talk to this graph in just a minute. But the complexity of the interplay of supply and demand, since we came into that regime of supply and demand interplay in the 80s, is such that we have always had a very narrow margin between crude oil production and crude oil demand. A lot of times that margin, and I will show it in a few videos for going forward, we usually not more than 1 million barrels, 1.5 million barrels. And most often, that margin favors demand. So you have a narrow margin of about 1 million barrels of demand higher than the supply. So the equilibrium is such that even if there was just the perception of a crisis between Iran and Iraq, and then just the thought that 2 million barrels could be taken out of the market, it will send prices up. Now, if that crisis happened and it didn't take 2 million barrels out, or probably didn't take any volume out at all, it will send prices crashing. So it's an interplay of supply and demand, but the political circumstances that actually get into this interplay are so complex that no one has been able to predict very accurately crude oil prices. But on the whole, if you plot the graph from where we were, $2.70 in 1971, to where we are today, and you make provision for proper annual inflation, international inflation, we are probably not far away today than where we should have been if that oil price were a straight, smooth graph. If you took 2 or 3% annual inflation from 1971, we'll probably be about $70, $80 oil today. So even though you see spikes, peaks, and troughs, inside that, it's actually a smooth graph going from $2.70 in 1970 to about $70 today. That's where it should have been. But speaking to this, bringing back home in our own policies as they affect the oil and gas activities in Nigeria, what you will see at some point there is when you start seeing production dropping. Again, because that was a period we had a policy that made it impossible for any exploration work to go up. We had what we call official selling price announced by the OPEC ministers. And at some point in 1985, the actual price in the market, the realizable price, was lower than the official selling price. And you needed to pay your tax and royalty using the official selling price. So it didn't make sense to even produce. Because when you calculate your tax and royalty, there will be nothing left. And then in 1985, we came up with famous MOU, Memorandum of Understanding. And the impact of the MOU was essentially to adjust the tax law in such a way that producers, that is operating companies, use their realized price to calculate their tax and royalty and make some profit. After that MOU, which you see there in 1986, then you started seeing a gradual climb in production from about what it was at about 1.3 billion barrels a day up to about 2 million barrels a day. And since we got to that peak in about 1988 to 1990, we have stayed gradually around that 2 million barrels, 2.2, 1.9, depending on how the crisis in the Niger Delta happens. So again, this is just a classic illustration of how our policies can affect the actual investment in the oil and gas industry. The MOU in 1986 led to one whole decade of massive investment in exploration and development, and we're able to maintain a steady production rate above 2 million barrels a day and kept that margin no matter what happened. It's even more dramatic for gas. In the case of our gas industry, we saw a situation where up to 1999, if you take our entire industry from 1960 to 1999, for 39 years, our gas production was about 400 million scf a day. 400 million scf a day. That's what it was. The reserves, even though I put the reserve figures in the bar chart there, even those figures are not reliable, because at that time, we had no reason to keep tab of our gas reserves. It was considered for its nuisance value, so nobody really was accurately calculating what reserves we had in gas. But look at the production. So we stayed flat there at about 300, 400 million scf a day until the LNG Train 1 came in 1999. And then you see the sharp rise in production, going up to about 3 BCF a day by the time trains 4 and 5 of the LNG came in. So again, up to 2011, 3-4 years ago, the bulk of our gas production was actually going to LNG. Production here, I'm talking about production that is used. The rest of it, of course, was fled. Now, before we finish discussing today, you are going to see this will be one of the kernels of our discussion today. Because what is happening to domestic consumption. If you strip away LNG from this graph, domestic consumption up to 2011 still remained about 300 billion scoff a day. And that's the sad story of what our gas industry was. That graph there, just keep an eye on the green line and the yellow line. It simply talks about demand balance. And you can see that the two graphs track, which means there's almost equilibrium between demand and supply. I'm taking this graph just from first quarter of 2009 to first quarter of 2015. Now you will see that up to about third quarter of 2013, consistently what we're seeing was a 1 million barrel gap between supply and demand. That is, the supply was a little higher than the demand. It kept prices high and sustained over that whole period above $100 per barrel. And then the North American unconventional oil didn't start yesterday, but gradually production from unconventional oil started getting into the market in increasing volumes. Once they exceeded about 2.5 million barrels per day, that tipped the balance, that supply-demand balance. And as you can see in the area with the red circle there, we then started seeing that the supply was outstripping demand. Even as we speak today, supply is outstripping demand by about 1.5 million barrels a day. Now, this was happening at a time when demand projection, see, I said it's always the projection or the perception of what will happen in future that affects prices more than reality. So when you say China and India will grow at 8 and 7% respectively, and you revise that growth and it becomes 5% high enough, but then that takes the projected demand from those two huge countries. It can take away 1.5 to 2 million barrels from that projected demand. So if you are getting a supply glut at a time when the demand is also slowing down, what you see is what we found at the end of 2014, a sharp decline in price. Again, the decline, the rate of decline was a reaction to nervousness more than anything else. And as you would imagine, in the next few quarters, we'll actually stabilize at an equilibrium price that will be determined by the supply-demand balance, which is really what the Prof was saying. That's what Saudi Arabia decided to do. Because when this price drop happened, Saudi Arabia and Kuwait would have taken 2 million barrels out of the market, and you restate the price at $80, probably still at $80. And at $80, the $50, $60 production from unconventional oil in North America will still be profitable. And so what the Saudis did was, well, we will not continue to subsidize high-cost producers from North America who are the ones tracking the price down. So let's all go on and produce at our peak, and let's see who will blink first. And remember, Saudi Arabia, with over $700 billion in sovereign wealth fund, can afford to go on without oil revenue for 3 years. I mean, it will hurt, but they can afford to go on without oil revenue for 3 years. That's the size of their sovereign wealth fund. The same thing with Kuwait. So they could do that. And they said, in fact, when the price first dropped, Saudi Arabia actually increased production rather than taking volume out of the market. And the price crashed. And so we're seeing who is blinking first. If you watch the rig count in North America, it's dropping, because there are fields in North America that cannot survive even at $60. So eventually we will see, and it will take some time, it will take a minimum of 6 months, as we're seeing, to 1 year to find that price equilibrium. So the rig counts will drop in North America. The fields that will not make money at $50 will drop off. Some deep water production from Brazil will drop off. Deep water developments, even here in Nigeria, have been scaled down. The results of all of these reactions to this oil price will start taking full effect Q1, Q2 2016, by which time these activities would have taken 2 million barrels, other 2